Welcome! Today, we're going to do something really useful. We're pulling back the curtain on how financial pros actually figure out if a company is healthy. And we're not just talking theory. We're using the pharmaceutical giant SANOFI as our real-world example. We're going to break it down piece by piece.
So, here's the big question, right? How do experts really decide if a company is a solid bet? When you see analysts talking about a stock, what are they actually looking at? Well, that's what we're about to demystify. We're walking through the exact process they use to turn a whole sea of data into a clear, understandable picture. Okay, before we dive in, you always see a disclaimer like this. And I know, it's easy to just skip past it. But don't. This isn't just legal stuff. It's actually the very first rule of smart investing, knowing that nothing is ever guaranteed. You have to start with that, knowing that the future is always uncertain.
So here's our game plan. First, we'll look at the big picture, the entire pharma world. Then we'll zoom in on SANOFI itself. After that, we'll run a full financial health check, see what all that means for an investor, and finally, we'll weigh the future risks and rewards. It's a guided tour, and we're starting right now.
All right, first things first, we have to understand the world SANOFI operates in. You see, before you can analyze any single company, you got to zoom out and look at the whole industry. It's all about context.
The good news for a company like SANOFI is that it's operating in an industry with some serious tailwinds. I mean, think about it. We have an aging population worldwide that needs more healthcare. We have nonstop medical innovation, and this is a sector that tends to hold up well even when the economy gets rocky. So the main takeaway here is that SANOFI is playing on a field that's not just stable, but actively growing.
Okay, so we've set the stage. We know the world. Now, let's bring our main character into the spotlight. It's time to zoom in and get to know the company at the heart of our case study, SANOFI.
So what is SANOFI? Well, it's a true giant. It's a world leader in vaccines, a powerhouse in those over-the-counter products you buy at the pharmacy, and crucially, it's got a massive research and development pipeline with over 60 projects cooking. That mix is really important. It shows they're diversified.
And if you want to get a sense of just how big we're talking, get this. SANOFI has a presence in over 100 countries. Now, that doesn't just mean more sales. It means they aren't overly dependent on any one country's economy. It's a simple number, sure, but it speaks volumes about their global strategy.
All right, now for the fun part. Let's pop the hood and take a look at the engine. Think of this next section as a company's annual checkup. We're about to look at the hard numbers, the vital signs, that tell us just how financially fit SANOFI really is. Now, before we flash a bunch of numbers, let's quickly talk about one key metric you'll see, the PE ratio. The easiest way to think about it is like a price tag. It just tells you how much you're paying for every dollar the company earns. Usually, a lower PE ratio is seen as more attractive, like you're getting more bang for your buck. Okay, here are the patient's vitals. That PE ratio we just talked about, it's looking pretty attractive for its industry. The return on equity, or ROE, shows that it's solidly profitable. And this one's really important, the debt to equity is low, which means the company isn't drowning in debt. It can pay its bills, and it runs its business very efficiently. So if this were a doctor's report, it would come back with a clean bill of health, a very stable, well-managed company.
So, we've established the company as healthy. Great. But what does that actually mean for the people who own a piece of it, the shareholders? Let's switch gears and look at it from an investor's point of view.
Okay, this is pretty remarkable. For 30 straight years, SANOFI hasn't just paid its shareholders a dividend, it has increased that dividend every single year. I mean, think about that. Through all the economic ups and downs, that number has gone up. That kind of track record is incredibly rare, and it sends a powerful message about stability and commitment.
And you can see it right here. No crazy spikes or dips. It just looks like a steady, predictable staircase, reliably heading up year after year.
So you might be wondering, how can they afford to keep doing this? Well, they pay out about 75% of their profits directly to shareholders. Now that might sound high, but here's the key. Because the company's profits have been so darn stable for so long, analysts believe it's perfectly sustainable. And now for our final section. Resuming back out again to look at the future. We've seen all the strengths, but now we have to be realistic and balance those against the challenges that are definitely on the horizon.
And here it is. This is the fundamental tug of war in any investment. On one side, you have the potential good news like strong earnings or a new drug getting approved that could boost the company. But on the other side, you've got the hurdles. Governments pushing to lower drug prices, key patents expiring, and the ever-present risk that a promising new drug just doesn't work out.
So, after all that, what's the bottom line? According to these projections over the next year, the total return, that's the stock price change plus that reliable dividend, is estimated to be somewhere between breaking even and a gain of about 17%. What that really tells you is this isn't some get-rich-quick stock. It's a forecast for modest, steady returns, but with the very real possibility of just staying flat. So, to wrap this all up, the analysis shows Sanofi as a classic, mature, blue-chip giant. It's stable, predictable, and it's been incredibly good at rewarding its owners. But all of that stability is constantly being tested by fierce competition and the high-stakes gamble of drug development.
And that really leads us to the final big-picture question. In a world that's changing faster than ever, is a long, 30-year history of stability a company's greatest strength, or could it actually be its biggest weakness, making it too slow to adapt to what's next? That's the real question to ponder. Thanks for joining me on The Explainer.